Hi, my name's Kurt. I'm a value investor, and today we're going to be looking at Nvidia stock. We're going to analyze this stock and see what is its intrinsic fair value. On X, I've been posting over the last couple weeks that maybe Nvidia is the best value opportunity in the Magnificent Seven. And although I've been recrunching the numbers and analyzing all this Magnificent Seven companies again intently to see if that's actually the case, it's actually pretty high up there, and maybe it's not number one, but maybe it's tied for number one. So I'll show you that in a second. But just an FYI, this is based on fiscal year 25, quarter four financial data as the latest. And when they have new financial data come out, then this will be potentially obsolete. Things might change a little bit. Things might change a lot into the future. But this is stock analysis for Nvidia. Is it the most undervalued stock in the Magnificent Seven? That's a huge question. I never would have thought that I would suggest that, because as a value investor, Nvidia has always been like pie in the sky, crazy valuation, too expensive. But let's see. I mean, it depends on what you think it's going to do in financials in the future. Here's the chart comparing the different Mag 7 companies, and you can see in this left column here, I have my value rating. That's my own rating, my own calculation that I make based on these other components like the value to price ratio and the 10-year expected return and these business pillars, which are really important. The business pillars kind of tell you, based on 8 different criteria with sub-criteria for each one, how steady the company is, how predictable it is, and how solid is the business fundamentals. So looking from a balance sheet debt perspective all the way to consistency of profit and free cash flow and revenue, and the overall valuation. So it combines a lot of different things. So the higher the pillars, the more stable and projectable that company is in terms of looking at their being able to project what's going to happen with the future of the company. So I combine all these different things into a value rating. You can see Microsoft and Nvidia are actually tied for the most undervalued, so to speak, or the best value of the Magnificent Seven. And Google is right behind them. And Meta and Amazon are also good value ratings. 7 and above I consider decent opportunities. Apple is sitting there about a 5 out of 10, very mediocre, not a great value opportunity, obviously. In fact, the value to price ratio, the true intrinsic value in my base case assumptions is $234, but their price is $278. So if I want to beat that discount rate, then they're just overpriced right now. Same thing, Tesla is absolutely crazy overpriced, and I could catch a lot of flack for that, but another video, I'll go over my numbers for Tesla, Apple, all those other companies, and why I got that intrinsic value number based on what I think they're going to do in the future financial-wise, and compared to their current price. It's absolutely absurd. And by the way, the business pillars are really bad for Tesla, the consistency in the past and other things like that. Apple's very consistent, but it's overpriced. The rest of the companies I see as underpriced, undervalued, which is a little bit crazy. There has been a little bit of weakness, well, mixed results. In the last year, definitely all these companies have been strong, but their earnings have been growing. And we're going to talk about the big theme of AI when we're talking here today about Nvidia. But just, you can see the value to price ratio, 1.29 for Microsoft, 1.34 for Nvidia. It's the highest in the Mag 7. But I also look at the business pillars. I mean, the pillars for Nvidia are slightly less than the pillars for Microsoft. Just that predictability of what their financials are. Nvidia, I even think these pillars may be a little bit misleading, because we're going to talk about can we really project that high level of growth for Nvidia? Maybe, maybe not, but it's sort of up to you to decide, make those assumptions, and then find a fair value that you feel very convinced about and very very confident in if you're going to invest in the company. But yeah, I think 250, I mean, this is sort of a hint for the end of the video, 250 intrinsic value about, and the price is 185. So a 10-year return is 12%, and 64% of the time when I run my model, the intrinsic, when I change the variables of growth and discount rate and everything and terminal multiple, 64% of the time, Nvidia is the intrinsic value is higher than its current price, which is okay, it's pretty good. But of course, Microsoft has less variability, I think, overall, and that 80% is a lot better in terms of if you want to make sure you're going to get a higher return than the discount rate. So let's look at Nvidia. Why? Why do I say that they're undervalued, that they're underpriced? First thing we have to do when we analyze a company is, what does the company do? What's the bare basics of the company? How do they make money? And in the case of Nvidia, they make money by designing high performance computer chips and systems that power AI, gaming, and data center computing. Those are data centers and AI are huge right now. And that's why Nvidia has absolutely exploded. They're now a $4.5 trillion market cap company. As of the time that I was putting these slides together, that's the number one company in the world. They're the most valuable company in the world. Why are they the most valuable? Because all of these huge companies, other major companies, are spending tons of money buying Nvidia's products, their chips, so that they can expand their AI and their cloud computing platforms. So Google, Amazon, Microsoft, they are spending tons of money in capital expenditures buying from Nvidia. And Nvidia is raking in all that cash. Those numbers there, 85, 88, 80, those are from fiscal 25. Some of these companies have put out earnings already for fiscal 26, first quarter earnings, or for calendar year 26 rather. Microsoft, almost $150 billion of CapEx planned. Amazon, I think almost $200 billion. Maybe I'm wrong on those numbers, but huge capital expenditures, larger than last year in a major way. And I mean, everyone's talking about that. Their free cash flow of these companies is going to get hit, and we can talk about that in another video. But all of that CapEx is going straight to Nvidia. And there's other companies that are obviously part of that CapEx, but Nvidia is a big part. And so Nvidia is capitalizing on this huge AI boom, and these companies investing in AI infrastructure, cloud computing. And that extends to other major companies, including even foreign countries. Companies in foreign countries and foreign governments are trying to get Nvidia to make stuff for them. Everyone wants to join this AI party. So that's how Nvidia makes money. That's why they've exploded. And you can see here's the price history in the last few years. I mean, they've gone from, this is adjusted based on their stock splits and stuff, but I mean, just in 2022, they were down here equivalent $25 a share under, and then they've exploded. And then we had the tariff sell-off, and that's when they went from $150 a share down to under $100 a share. Yeah, it would have been a great time to buy because they popped up again. They peaked over $200 a share, and they're back down. They're not quite at their 200-day moving average, but it's pulled back just a little bit, and maybe that's what it is. That's providing that little opportunity. So right here, while they're pulling back, maybe their price is dropping below that intrinsic fair value, depending on how you look at their future financials. So yeah, if you had bought here, you would have done really well. If you had bought here, you would be kind of sad right now that they're down. But what about right now? They're about $185. Is this a good buy? Is this a good buying opportunity? What's their intrinsic value? Is their intrinsic value $50 a share? We don't know yet. Let's look at their earnings. Well, let's start by looking at their revenue. This is and when you saw that price spike up, it's because that was the moment that everyone said, wait, these chips do what we need them to do for AI computing. So Nvidia got huge explosion, huge boom. And you see, these are numbers that we really rarely, never see. The 10-year growth annualized 44% going back to 2015. 5-year growth going back to 2018. 2020. 66% per year. It's all in this hockey stick right here. And that's the same thing you see with revenue, that you see with profit, has been even more extenuated. Like, look at the 3-year annualized growth over 100% in profit. It's just absolutely crazy. And they have these high margins now because they're one of the only people who can make these chips. They're so valuable. Just once they've figured it out, they've got it. And they've got now here's the analyst estimates over the next 2 years, 60% per year growth. That's unheard of. Is it far-fetched? Not based on these numbers, not based on those numbers. So, okay, are we going to plug that in? I don't know if I would go that far, but that's what analysts are saying. So, okay, how about free cash flow? Same looking chart. Have they been spending a ton on CapEx? Not as much. Everyone else is spending on CapEx, buying from them. They're the ones reaping the benefits. And so when we talk about this profit versus CapEx profit versus free cash flow, because capital expenditures comes out of profit. And so free cash flow is the operating income minus capital expenditures. And of course, Nvidia has some capital expenditures, but it's not that crazy. So look at these free cash flow numbers. I mean, annualized growth, 80%, 90%. It's crazy. I mean, it's true. Look, I mean, here's 2024. You're sitting at, okay, a year later, you're almost doubling. That's insane in terms of free cash flow. Now, here's their shares outstanding. I always like to look at shares outstanding, make sure that, hey, maybe that revenue growth is because they're blowing up shares and spending, that they're diluting and using the cash coming in to fund whatever. No, I mean, Nvidia has found gold. Their product has been turned, everyone in the world has turned to their product. They were developing it back when they were doing gaming and stuff, higher performance computer chips, and all of a sudden they're necessary for something that people are doing in everyday life, AI. So they haven't needed to dilute in order to have this extraordinary growth. So that's even better. And now they're actually buying back shares more than 0.5% per year in terms of their shares outstanding. Over the last 3 years, I think it's probably closer to 1% per year now. To buy back 1% of a $4.5 trillion company per year is a lot of money. But guess what? They have the money. They have the free cash flow coming in to buy back their own shares. So when we combine the profit and free cash flow trend with that trend in shares outstanding slightly decreasing, you get even, new numbers. I mean, free cash flow per share, earnings per share, here's your numbers. Now, the point in looking at this is saying, okay, I want to look at their history. What's going on? Where are they right now? Therefore, how can I project them into the future? I mean, are they going to keep growing at 90% per year in earnings? I don't know. I mean, I really, maybe, but let's say, okay, I want to be conservative because I want to have an estimate of their fair value that I can believe in, even in a bad or worst case scenario. Okay, they're growing at 90. Maybe they'll grow at 60. Maybe they'll grow at 50. That's still too high. I'm not comfortable assuming that kind of growth. Maybe there's a slowdown. These companies start to finish up their big CapEx and then they start to spend a little bit less, and the investors of Google and the investors of Amazon are not happy with the high CapEx. And so maybe they slow down in 2027, 2028, and we go down from 80% growth per year to 40%, maybe 30%. So that's why I'm looking at these charts going, okay, is there net income per share? Is it slowing? Is this growth kind of slowing down a little bit? Maybe. So let's keep that all in the back of our mind. Look at return on invested capital. Of course, 100%. I mean, I put this line at 10%. Usually it's not this low on the chart, but of course, Nvidia has blown everything upwards. The 10% is like a good company that's not super capital intensive should be getting returns on invested capital, consistently higher than 10%. Well, Nvidia was doing that before the AI boom. They were just barely above that line. And then since the AI boom, they've been really getting huge returns on their capital, obviously. So, but the point there is that the company, the management knows how to deploy capital and get high returns in terms of what they do in the business. Here's their dividend history, just as a snapshot, just for context and to understand. They've had a dividend since 2013. So they're sort of beholden to a dividend because their investors in their shares before the AI boom had a dividend coming in. So they've been expanding the dividend along with their free cash flow. You can see the huge growth here, almost $1 billion in dividends paid to their shareholders per year. So that's going to continue to expand if their free cash flow keeps growing. Now let's take a look at their balance sheet. And I have to admit that when it gets this crazy, when a company gets this big, the balance sheet's sometimes a little bit tough to understand what's going on. I'm not going to sit here and pretend like, yeah, I understand what all their assets are and their liabilities. One thing that's interesting though is that $33 billion they have in accounts receivable. That means companies have ordered their product, that they've been preparing their product or delivered their product, and they haven't been paid yet. The $33 billion is stuff that they've delivered to their customers, those big companies, but those companies haven't invoiced for them and haven't actually paid them the money. So that's $33 billion coming in, and that $33 billion covers their current liabilities, plus the cash they have. They have $11.5 billion in cash on hand, not that high relative to the $26 billion in current liabilities, which probably includes stuff that they've been paid for but haven't delivered yet. So it sort of balances out in the end. Overall, I'd like to say that based on their debt, they have tons of assets and a good amount of cash and current assets to cover their liabilities. So they get a good check mark. Now, I always adjust a company's balance sheet with a little bit of an adjustment against their assets to make sure, because sometimes I don't know if Nvidia is inflating the value of the assets on their balance sheet. I mean, what is the intangible value of the brand of Nvidia? It's tough for me. They're going to say, and an accountant supposedly looks at it and says, yeah, this is good for the SEC, but I go ahead and adjust everything. Some companies I adjust more than others based on what's in their actual assets, what's in their balance sheet. So when you get financial companies, they'll have allowances for credit losses and all that. You have to look into a little bit more. But their adjusted book value, their real book value is $119 billion, which is crazy huge. Their adjusted book value, when I take a step back and say, I'm going to be conservative and just say, let's say everything goes bad for Nvidia and they have to write down some of their assets and I take away their liabilities, $78.6 billion, which is only $3.23 a share. So if I were to not adjust, okay, it'd be $5 a share. It's nothing. It's a drop in the bucket. The value of their assets, the value of their balance sheets, a drop in the bucket compared to what is the value of their free cash flow in the future. Sometimes for some companies, the value of their balance sheet is a huge portion of their actual intrinsic fair value today because they have a lot of assets and their free cash flow is not growing as much. But for a company like Nvidia, okay, we've done our little balance sheet adjustment, but it doesn't really matter. What is their free cash flow in the future? That's what's important. Here are their business pillars. I just took a screenshot from my template, my tool, and you can see all the different sub pillars and pillars that I use. The one pillar that they don't satisfy is the valuation pillar. And that's when looking at their current price to earnings or current price to free cash flow, taking away book value and stuff like that. So obviously, a company who is growing really fast is not always going to meet my criteria for valuation. So that criteria is just there to say, pop up and rate companies a little bit higher if they're currently really low priced relative to their earnings. But Nvidia has checked off 7 of the 8 pillars and 19 of the 22 sub pillars, which means other than their current valuation, all this stuff is checked off green. They're meeting everything from their debt levels. Their shares outstanding are going down, meaning they're not being diluted. Net income has increased consistently and at a high rate. Revenue, their dividend is manageable. Obviously, it's a tiny little dividend compared to their actual earnings. So they have very, very, very fundamentally sound pillars. Very, very fundamentally sound company. But Nvidia has a very short history of meeting all of these criteria because in the last 3-4 years, their earnings have grown. Before that, were their earnings growing so steadily? No, not necessarily. So the question we just have to ask is yeah, they're meeting all these pillars, but could it be deceiving because is their current trajectory and their current pace of growth really sustainable? And more than that, is it really predictable? How well can I predict a company that's moving so quickly in such a dynamic industry? AI, cloud computing, this is changing very fast. Right now, Nvidia doesn't have that many competitors. What happens in a few years? Am I able to know what's going to happen in a few years? That's the question I have to answer when I'm applying these business pillars to kind of how I see the valuation of the company. So keep that in mind. As I go to my valuation page where I show you, okay, here's the assumptions that I made. I said, let's say this year they're making $59.5 billion in free cash flow. In reality, they're making closer to 80. I always start with a base year lower than the actual number. Their net income is closer to $100 billion. Their free cash flow is closer to 80, but I always handicap a company's base year free cash flow. In the case that we had a recession and some companies had to cut back and Nvidia, their profits go down. Now I'm forecasting from a lower base. So I've already, in all my valuations, I'm already trying to account for some sort of recession. Let's say the earnings drop a little bit. Then I'm going to grow the company at 30% per year. 32% per year for the next 3 years, 24% per year for the next 3 years after that, and 18% per year for years 7 through 10. And the terminal price to free cash flow multiple that I think the market will evaluate the company at is 25x. I think the shares will decrease by 0.5% per year for the next 3 years, 1% per year after that, next 3 years, 1.5% after that. I think the dividend will go up 20% per year over the next 3 years as their free cash flow is growing 32% per year. So those usually stay in line. I think their earnings will grow faster than their dividend right now until they get more mature, in which case they'll balance out a little bit better. And I'll set the discount rate at 9%. I pick all these things based on what I'm comfortable with. You could say Nvidia is going to grow 50% per year for the next 3 years. But I'm sitting here going, I can't confidently say that. I can confidently say 32 sounds very feasible for Nvidia. I pick a number until I feel comfortable. I try not to go super, super pessimistic, somewhat what the trajectory is telling me, but something that I don't want to lose sleep at night going, are they actually going to live up to that? Are they actually going to live up to that? So those are my numbers. You can plug in 50, 40, and 30 if that's what you really think, and you're going to get a much higher valuation than this. You can pick that their terminal multiple in 10 years will be 30, 35. So be it. I think 25 is really high for a multiple for a company in a regular economy. Right now, the last few years, multiples have been really high. And I picked a 9% discount rate. I have a little formula based on sort of the reliability, the certainty of projection of the company. If it's better, it goes down a little bit. If it's less certain, I put the discount rate up a little bit. I crunched the numbers. The 10-year expected return at the current price, $185 if you bought today, 12%, which is pretty good for one of the best companies in the world. Now, again, if you put in 50% growth, 40% growth, 30% growth, you're going to get closer to 20%, expected 10-year return. This return is if you bought it today and held it for 10 years and then sold it at this, and the market was pricing it at that multiple, then you'd make that return, which is higher than the discount rate that I'm picking for this company. So therefore, the company's undervalued. So the current intrinsic value per share, as I showed on my first page, I think I said $249 there. So I just rounded it to $250, which means currently there's a 34% margin of safety if you buy Nvidia today, which to me sounds crazy because 2 years ago when Nvidia is blowing up and the price is skyrocketing, I'm going, no way they can grow that fast. But guess what? They have. And it looks like they're going to continue to based on what other companies are planning to spend in CapEx. Here I just show the model output. This is just a histogram of what different iterations of my model show. I do 2,000 iterations, and there's the frequency of the expected return. You can see that 11 to 13% right in the middle, where we have this 12% is the most frequent, or the average, or the median of these. But yeah, I mean, from 9 to 15% are the 3 bars in the middle, and it's a very low chance, according to my model, of the expected return of the return being negative. But you also have the tail end of this here where based on random events where the growth is higher, because I randomize the growth according to some standard deviations, you get growth higher than 20% per year. So it's very possible, but also something very low. According to my model, it's more possible to get lower returns overall than to get these tail higher returns that are crazy. But that's my model based on the assumptions that I picked. You pick your own assumptions, you run your own Monte Carlo simulation, you get something different. So it's all based on your assumptions. If you think these are super safe assumptions, then you should say, well, it's undervalued by a lot then. So in summary, Nvidia has had tremendous growth, tremendous momentum, but you have to ask yourself these basic questions. Will it keep up this amazing growth for so long? Like, how long will it go? Can it keep growing like this for the next decade, for the next 10 years, for the next 5 years? What happens if we have a big recession? What happens? Do companies just pause their programs? I mean, what happens to Nvidia? they've been growing super fast, maybe they can fall really fast too, just because that's the nature of the game right now. How predictable is the actual growth of the company's free cash flow? You have to ask yourself, if the answer to you is, oh, it's so predictable, then you have conviction, you have what you need. Me, I'm not so sure. I'm not 100% convinced. I think the numbers are conservative, but there's such a wide range of things that can happen with a company growing so fast. I can't sleep at night knowing, yeah, that's really predictable. But according to my base case, my base assumptions, 12% expected return for one of the most dominant companies in the world. They have very good business pillars. If they continue to grow the way they've been growing, I would, if I was convinced about this company, I would seek to buy as long as they're under $200 a share, because then they're super undervalued. And I would own it right now, unless the numbers change in the future. Own it as long as it's under $300. Own it as long as it could go above $250 per share, the intrinsic value. Just let it run up. I'd own it probably under $3. If I bought it today and it went up above $250, I'd keep owning it until it's under $300 per share, or until I find a much better opportunity to invest the money. Overall, it's a value rating of 8, according to my numbers, which is very good. It's a very good value rating. There's still going to be question marks, and it's something that maybe if you know more about the industry, or if you're more certain about answering those question marks, then it's probably a pretty good investment. One of the best in the stock market, and tied for the best in the Magnificent Seven. So with that, let me know what your thoughts are on Nvidia. Comment down below. What is the intrinsic fair value for Nvidia? Do you own it? Can you stomach owning it right now? What are some of the growth assumptions that you have that I can plug into my model? Comment down below your assumptions to change on that slide before. I'll run the numbers and comment back what the intrinsic fair value would be based on those assumptions. So that's it for now. Thanks for sticking with me on the Nvidia valuation, and more stock valuations coming soon. Best of luck investing next time.